Welcome back to the Deep Dive. Today we're really digging into Quanta Services, Inc., that's ticker PWR on the NYSE. They're this huge infrastructure player right at the heart of some massive trends. Energy transition, fixing the grid, and of course the AI data center boom. Yeah, our mission here is to cut through the noise, look straight at the numbers. Quanta's definitely a leader, no doubt about it, but, the market seems to be pricing it like a tech stock, not really like a contractor. Shares are sitting at $402.62. So the big question for you is, well, is the market right? Or has it gotten a bit ahead of itself? We've got an intrinsic value range, $380 to $420, and we'll tell you where things stand.
Exactly. That's what we're aiming for. And just so everyone's on the same page, all this analysis, the management stuff, the valuation, it's all based on data right up to September 25, 2025.
Okay, let's get started. Part 1, the foundation.
Right.
First up, Chapter 1, the business of building tomorrow's infrastructure.
So what exactly does Quanta do?
Well, they're not just, your average construction firm. They provide these complete end-to-end solutions for electric power, energy infrastructure, communications, the whole package. And the really key thing, they do over 80% of the work themselves, self-perform.
And that 80% self-perform stat, it's not just a detail, it's critical. It cuts down on execution risk massively. When they bid on these huge long-term utility projects, the client knows Quanta's in control, the schedule, the quality, finding the skilled workers.
Yeah.
It's a real competitive moat.
Makes sense. So looking at their numbers from 2023, the biggest chunk of revenue, like 65% or $13.1 billion, that came from infrastructure construction contracts. That's the growth engine, right?
That's the main engine, yeah. But what gives them that foundation, that stability, is the other part. About 18%, $3.6 billion, comes from these long-term maintenance service agreements.
The predictable stuff.
Exactly. These contracts run for 3, sometimes 5 years. That gives them amazing visibility into future revenue. It's not just project to project. And that stable core leads to something we call a quasi-regulated profile. Think about it. Around 83% of their 2024 revenue came from utility and power companies.
Right, whose spending is basically locked in years ahead by regulators.
Precisely. Multi-year regulated capital programs dictate their spending. So Quanta gets this resilience, this predictability.
Yeah.
It's pretty rare in the construction world, which can be, quite volatile.
And their main focus area is electric power infrastructure, so transmission lines, substations.
That's the core, yes.
Yeah.
Transmission, substations, distribution, and now increasingly connecting all the new solar, wind, and battery storage projects to the grid. That's a huge growth area.
And the scale difference is just massive, isn't it? Market cap is $60 billion.
$60.03 billion, yeah. It just dwarfs the competition. You look at MasTec, they're around $16.25 billion. Dycom, about $8 billion. Quanta is really in a league of its own in terms of scale.
Okay, you don't get that big without strong leadership. Let's talk about that. Chapter 2, evaluating the architects of growth.
Definitely. The team, led by CEO Duke Austin, he's been an insider since 2001, really steered the ship through major growth they've shown. They know how to allocate capital. It's not just growth for growth's sake. It's strategic M&A.
M&A being mergers and acquisitions.
Right. Adding capabilities, not just size.
Yeah.
And we've seen that play out perfectly with their recent moves into the data center space, chasing that AI infrastructure demand.
Oh, yeah, the big acquisitions. Cupertino Electric first.
That was 2024, $1.54 billion for Cupertino Electric, or CEI. That move got Quanta inside the data center doing the critical electrical work.
And then they added the plumbing, basically.
Sort of, yeah.
Yeah.
Last year, 2025, they bought Dynamic Systems, Inc., DSI, for $1.35 billion. That added the mechanical, the plumbing, the HVAC systems, crucial for keeping those data centers running.
So put those two together.
Put them together, and it's a game changer. Before, maybe Quanta built the highway to the data center city. Now, they own the crews building everything inside the city's buildings, too. From the power generation right up to the chip level, it's this incredibly powerful single-source offering.
Okay, that sounds great strategically, but does it actually make financial sense? Is it adding value?
That's where we apply the ROIC test, return on invested capital. We need to see if the return they're getting on all the money they've invested, including these big acquisitions, is higher than their cost of getting that money.
And is it?
It is. Their ROIC on a trailing 12-month basis is 9.6%. And crucially, it's trending up. We estimate their WACC, their weighted average cost of capital, is somewhere between 8% and 10%.
So 9.6% beats that range.
It does. When ROIC is consistently higher than WACC, that's the textbook definition of creating economic profit. The M&A strategy isn't just empire building, it's value accretive. It's working.
Got it. So the growth focus is paying off in terms of value creation. But the flip side is maybe not much left for shareholders directly.
That's the trade-off you see. They clearly prioritize reinvesting for growth. Look at the dividend yield, it's tiny, 0.10%. And share buybacks have been pretty inconsistent. Growth first, shareholder returns second.
Okay, the strategy makes sense, the growth is real. Let's get into the nitty-gritty financials. Chapter 3, a quantitative analysis of financial strength.
Yeah, the numbers themselves are pretty impressive. Over the last 5 years, revenue growth, the CAGR, is 14.4%. That pushed their trailing 12-month revenue up to $26.05 billion.
14% annual growth for an infrastructure company. That's strong.
It really is. And earnings per share, EPS, grew even faster, 17.4% CAGR. And maybe most importantly, free cash flow, the actual cash the business generates after investments. It's exploded, more than 5 times higher than it was in 2019, hitting $1.55 billion in 2024.
Wow. Okay, so huge growth, strong cash flow. What about margins and debt? Margins are usually thin in this industry, right?
They are thin, yeah. Net profit margin TTM is 3.73%. That's pretty typical for high-volume construction and infrastructure work. But crucially, they're stable. They haven't been eroding.
And the balance sheet.
Looks healthy, quite conservative, actually. Their debt-to-equity ratio is only 0.57.
Meaning they use much more equity than debt to fund themselves.
Exactly. It limits their risk if interest rates go up or the economy slows down. And their current ratio, which measures short-term liquidity, is 1.37. That means they have $1.37 in current assets for every dollar of current liabilities. Plenty of cushion.
Okay, so strong growth, solid cash flow, stable margins, healthy balance sheet. Sounds like a top-tier industrial leader.
It absolutely does, which makes the next number, well, kind of jarring.
The valuation, let's talk about that price-to-earnings ratio. It's
60.5x on a trailing 12-month basis.
60.5 for an infrastructure company. How does that happen?
That's the multi-billion-dollar question, isn't it? 60.5x PE. I mean, that's double their own historical average over the last 10 years, which was already a respectable 28.8x. And it just blows past competitors like EMCR, which trades around 26.7x.
So the market is basically pricing this like a high-flying tech stock.
Pretty much. The market is signaling a very strong belief that Quanta can keep growing at an incredible clip, maybe double digits, for years and years to come. Way beyond what you'd expect from a typical contractor.
But is that realistic? Or just hype? I mean, 60x PE usually implies tech-like margins or some unique product, which doesn't quite fit infrastructure services, however specialized they are.
It's definitely aggressive, it carries risk, but you could argue it's not completely irrational. The market seems to be pricing in the sheer certainty and scale of these secular tailwinds.
The grid modernization, the renewables, the AI data centers.
Exactly. Quanta is seen as the only company with the scale, the specialized workforce, the expertise to handle this unprecedented wave of spending. Every single one of these trends requires exactly what Quanta provides. They're viewed almost like an essential utility themselves, a bottleneck asset.
So the market thinks they have pricing power and a guaranteed growth runway.
That seems to be the bet reflected in the stock price. But it absolutely introduces significant valuation risk. If growth hiccups even slightly, or if margins get squeezed unexpectedly, a PE this high doesn't offer much of a safety net.
Okay, that sets the stage perfectly. We need to test that optimism. Let's move to part 2. Market, ownership, risk, and conclusion.
Right. Let's see what the broader market thinks and what could go wrong.
We kick off part 2 with chapter 4, gauging the market's temperature. What are the analysts saying?
Well, no big surprise here. Wall Street loves the story. The consensus rating is a solid, moderate buy or buy.
And the price targets?
The average 12-month target is around $425. So from the current price near $402, they see some modest upside, but not, a massive jump.
Okay, so analysts are bullish. What about the technicals, the chart?
The technical picture looks pretty strong, too. Short interest, that's the percentage of shares borrowed by investors betting the price will fall, is really low, only 2.79% of the float.
Meaning very few people are actively betting against Quanta right now.
Exactly. And the stock price is trading comfortably above both its 50-day and 200-day moving averages, which technicians usually see as a bullish sign.
So strong analyst support, strong technicals. Sounds pretty good.
It does, but there's a flip side to all this agreement. It points to a potentially crowded trade. If almost everyone is already bullish and has bought in, who's left to push the price higher?
Right. It means any disappointment could hit harder.
Precisely. If something negative comes out, a project delay, an earnings miss, The reaction could be more volatile because there isn't much of a skeptical or bearish buffer already priced in.
Okay, interesting point. Let's look at who actually owns the stock.
Yeah.
Chapter 5, ownership structure.
This is where it gets really interesting. Institutional ownership, meaning big funds, pension plans, mutual funds, is incredibly high, somewhere between 90% and 93%.
Wow, that's huge. Mostly index funds.
A lot of it, yeah. Big players like Vanguard, BlackRock, that provides a lot of stability because these giants tend to be long-term holders. They aren't usually trading in and out frequently.
Okay, so the big money is firmly planted. But what about the insiders? The management, the directors?
Now here's the contrast. If you look at insider ownership, it's remarkably low. Only 0.74% of the company's shares are held by insiders.
0.74%. That's really low for a company this size, isn't it?
It is quite low. And perhaps more telling is the pattern of their transactions over the last year.
Buying or selling?
Overwhelmingly selling. In the last 12 months, there were 21 insider sell transactions compared to only 6 insider buy transactions.
Okay, wait. So the big institutions are piling in, holding 90+%, but the people running the company own less than 1% and are net sellers.
That's the picture. Now, insiders sell for many reasons: diversification, taxes, buying a house. But the pattern here, combined with the very low ownership stake, is something you just can't ignore.
It kind of raises an eyebrow, right?
It certainly warrants caution. When the people who know the business most intimately are consistently reducing their stake, even as the market price hits new highs, it could suggest they view the stock as fully valued, maybe even a bit expensive. It hints at a potential misalignment, or at least a difference in perspective on valuation compared to the broader market. Low skin in the game plus consistent selling. It's a yellow flag.
That definitely adds another layer to the valuation question. Given that, let's focus squarely on the potential downsides. Chapter 6, risk assessment.
Okay. We know the strengths: market leadership, irreplaceable workforce, those massive secular tailwinds, but we need to really focus on the weaknesses and threats, especially those that could hit those already thin margins. We see what we call a triple squeeze on profitability.
Triple squeeze. Okay, break that down for us.
Squeeze number 1, the ongoing challenge of skilled labor. Finding enough specialized electricians, linemen, project managers. It's tough, and wages keep going up. That's a constant pressure.
Okay, labor costs. What's number 2?
Number 2 is just broad macroeconomic inflation hitting construction materials and equipment. Costs are projected to jump another 5% to 7% in 2025. Now, if you signed a big fixed-price contract 6 months ago...
You didn't budget for that kind of cost increase? Ouch.
Exactly. It directly compresses your margins on existing work.
And the third squeeze, you said it was more specific.
Yes, the third is a direct policy hit. Those newly imposed 25% U.S. tariffs on imported steel and aluminum kicking in during 2025. This is a significant input cost for Quanta.
How significant?
Steel, in particular, can make up anywhere from 15%, even 30% of the material costs on big projects, especially things like transmission towers and substation structures.
Okay, so if steel is, say, 20% of your costs, and suddenly there's a 25% tariff on that.
It adds 5% to your total project cost overnight,
Well,
to 0.25 up to 0.05. If your original gross margin forecast was maybe 8–10%, that tariff just wiped out a huge chunk, potentially most, of your expected profit, especially, again, if the contract price was already locked in before the tariffs were announced.
wow. So rising labor costs, general material inflation, and now specific tariffs on key materials like steel. That's a tough environment for maintaining margins.
It really is. It means management needs near-perfect execution, excellent project management, cost control, negotiating pass-through clauses where possible just to hold margins steady, let alone expand them in a way that might justify that very high PE multiple.
Right. Okay, brings us to the end game. Let's synthesize all of this. Chapter 7, conclusion.
All right. Let's lay out the bull and bear cases clearly. The bull case rests on incredibly strong pillars. Quanta is the undisputed market leader. They have a scale and skilled labor force that's almost impossible to replicate. They're perfectly positioned for decades of spending on electrification and AI infrastructure. And they have a management team that's proven it can make smart, value-adding acquisitions.
Solid bull case. What's the bear case?
The bear case is almost entirely centered on valuation and margin risk. That PE ratio of 60.5x is extreme for the sector, pricing in years of flawless execution and continued high growth. Then you have that persistent triple squeeze pressure on margins from inflation, tariffs, and labor costs. And finally, that signal from insider selling suggests even management might think the current price is stretched.
So weighing those two sides, what does our analysis land on the intrinsic value?
After running the numbers through our educational discounted cash flow model, which tries to account for expected growth, those risks we discussed, cost of capital, we estimate the intrinsic value range for Quanta Services is between $380 and $420 per share.
Okay, $380 to $420 per share, and the current stock price is $402.62.
Right in the middle of our range.
So the final verdict.
Our conclusion is that at the current share price of $402.62, Quanta Services stock is fairly valued. The market isn't necessarily wrong. It seems to have accurately priced in the company's high quality, its dominant position, and its excellent growth prospects.
Meaning there's not much upside left from here, based purely on valuation.
For a value-focused investor looking for a margin of safety, probably not. At this price, future returns are likely going to depend almost entirely on Quanta continuing to execute flawlessly and those huge secular trends playing out exactly as or even better than expected. The good news is priced in.
Fairly valued. A clear takeaway. That wraps up our deep dive on Quanta Services. Before we sign off, though, here's something for you to think about. We talked about Quanta buying those companies to build inside data centers, that generation-to-chip capability. What happens long-term if the huge AI companies needing massive, reliable power start deciding to build their own private power generation and microgrids, bypassing the traditional public utility grid partly or entirely? How would Quanta's unique integrated skill set position them to benefit even further from that potential shift? Something to ponder. If you found this analysis helpful, please do like and subscribe to Stock Analytics AI. And remember, for just $4.99 a month, members get priority access to our deep dives. We're tackling the entire S&P 500 over the coming months, and members get first dibs on which tickers we cover. One specific company analyzed. A super thanks is a great way to request a one-off dive.
And our standard but important reminder, this analysis was generated by an AI system. It's for educational purposes only. It is absolutely not financial advice. Always do your own research, dig into the company filings yourself, and consider consulting with a qualified financial advisor before making any investment decisions.